Welcome to What is Liquidity in the Context of Stocks. Right at the start, notice the quote, "Liquidity is oxygen for a financial system." This sets the tone. Liquidity is like the air a market breathes. Without it, even solid investments can suffocate. Think of Apple or Microsoft. Millions of shares change hands daily, making it easy to buy or sell without shaking prices. As you watch, remember you can grab the full PDF guide at the link in the description. It's a roadmap to mastering this concept. Imagine having that clarity before you make any trade. Slide 2. The agenda lays our path. First, we'll understand stock liquidity itself, what it truly means. Next, how to measure it using volume, spreads, and market depth. Then we explore why it matters for your investing security. After that, we compare high versus low liquidity stocks in real life. We'll follow with portfolio strategies, actionable takeaways, and personal reflection. See these points? Each builds on the last. By the end, you'll see liquidity not just as a number, but a guide for smarter decisions. Slide 3, why liquidity matters. High liquidity is smooth flow. Low liquidity is turbulence. This sets up the challenge. How do you avoid getting stuck in a stock when you need out? Think of a narrow stream. Even a small push ripples the price. A wide river like Apple shares absorbs large trades effortlessly. This matters for financial growth because timing is critical. You'll learn to act when conviction aligns, not when panic hits. Slide 4. Understanding stock liquidity. The first point, the ability to buy or sell shares quickly at stable prices. So that boils down to predictability. Fewer surprises when entering or exiting a position. Large cap examples like Microsoft are high liquidity. Small cap or penny stocks can leave you stranded. Think about your own experience. Ever tried selling a thinly traded stock? That friction is exactly what this bullet warns against. The second point highlights risk reduction. High liquidity reduces costs and timing uncertainty. It's a form of insurance for your portfolio. Reflection. Which stocks in your portfolio give you that confidence? Slide 5, measuring liquidity. Reveal 1, trading volume or the number of shares exchanged daily. High volume means plenty of buyers and sellers. Imagine Tesla on a busy trading day. You can move thousands of shares without impacting price. Reveal 2, bid-ask spread, the difference between buy and sell prices. Narrow spreads mean efficiency, wide spreads signal caution. Reveal 3, market depth, the orders lined up at various prices. More depth equals smoother trades. Quick check. Do you routinely monitor volume or spreads? Ignoring them could quietly cost you. Slide 6, importance for investors. First bullet, lowers trading costs and slippage. That's real money saved, especially on big trades. Second bullet, exit flexibility during crises. Liquidity is a lifeboat when markets shake. Third bullet, resilience. Liquid portfolios adapt faster. Think of the 2008 crisis. Investors with liquid assets recovered faster. Ask yourself, if your portfolio lacked liquidity, how differently would you have reacted? Slide 7, high versus low liquidity stocks. High liquidity examples, Amazon, Microsoft, easy trades, low volatility. Low liquidity, small cap or OTC stocks, prices swing wildly, exits are tricky. Reveal 2, this is the risk-reward trade-off. Low liquidity can give discounts but demands patience. Consider Peter Lynch's approach in One Up on Wall Street. Success sometimes requires navigating illiquid waters, but you must know when to get out. How comfortable are you trading thin markets? Slide 8, portfolio strategies. First point, allocate roughly 70% to high liquidity core holdings for stability. Second, 30% to selective low liquidity for growth. Third, use limit orders in illiquid stocks to control price impact. Fourth, monitor spreads and volume actively. Think of it like tending a garden. High liquidity stocks are the sturdy trees. Low liquidity stocks are the exotic plants that can pay off if nurtured carefully. Ask, does your current allocation reflect this balance? Slide 9, actionable takeaways. First, check daily volume over 1 million shares for core positions. Second, keep bid-ask spreads tight, ideally under 0.1%. Third, diversify across liquidity levels. Fourth, review your portfolio quarterly, especially before major life events. Fifth, track a personal liquidity score. These small, consistent habits compound into resilience. Pair this with the PDF guide at the link in the description to create your own action plan. Slide 10, personal reflection. Questions to ponder. Which stocks give you confidence in ease of exit? How would higher liquidity have changed past results? Are you willing to trade short-term liquidity for long-term upside? Reflecting like this is powerful. It shifts decisions from reaction to strategy. Imagine acting calmly during a market dip because you know your portfolio can handle it. Slide 11, conclusion. Liquidity isn't just a metric, it's the lifeblood of informed investing. Check volume before buying. Apply one strategy today, even something simple like reviewing spreads. Remember the Jamie Dimon quote, "It's the oxygen of the system." And yes, you can download the full PDF guide to revisit these steps anytime. Imagine this knowledge compounding over years. Smoother trades, lower stress, better outcomes. If you found this helpful, subscribe to the channel so you don't miss future guides that turn market theory into real action. Slide 12, disclosure. Affiliate links may apply. Full transparency. Keep learning, stay curious, and always tie liquidity back to your personal goals. Your next smart move could start with a single insight from today's deck.